The money you call safe can be the first money that gets played. Leave too much cash in a regular bank account, and three things start happening. First, inflation chews it up, quietly, every single month. Second, the bank's monitoring systems start caring about you, way more than you think. And third, the scariest one, your own legal money can suddenly become a question you have to answer. Not because you robbed anybody, not because you did something shady, because the machine saw a pattern, got nervous, and decided your life needed extra paperwork. That is the part nobody tells you. They sell the bank account like a vault, like a clean, boring, responsible choice. But for large cash reserves, it can become a false safe zone. And false safe zones are dangerous because you stop checking for exits. Look, I sit around people whose families built careers inside this system. I read the stuff regular marketing pages never show you. And the street translation is simple. The bank loves your deposits. They do not love surprises. So if you keep a serious pile of cash in the most basic account possible, you are taking inflation risk, visibility risk, and behavior risk at the same time. That is a trash combo. Legally, I gotta say, none of this is financial advice. Personally, I'd say it's just common sense they don't teach you in Econ 101. Let me show you the move they made on your parents, too. Meet Raymond, 68 years old, worked the same job forever. No schemes, no games. The kind of man who keeps every receipt in a folder. He sells a property share after a family settlement. Money lands in his checking account. A big amount for him. Totally legal. Taxes handled. Paper trail clean. A week later, he wants to move part of it. Some goes to help his daughter with a down payment. Some goes toward a contractor. Some he wants in a separate account because for once, he is trying to organize things properly. And that is when the circus starts. The transfer gets delayed, then flagged. Then he gets the call. Who is the recipient? What is the purpose? Why now? Do you have documents? Can you come to the branch? Raymond is confused because in his mind, this is still his money. That is the trap. You think ownership means frictionless access. The system thinks ownership means access until your behavior stops looking boring. And when it stops looking boring, the burden flips. Now you explain. Now you produce paperwork. Now you wait while somebody younger than your daughter asks why you need your own funds. And before somebody says, well, if it's legal, no problem. Actually, no. Let me fix that. If it's legal, that helps. It does not mean instant clearance. It does not mean no delay. It does not mean no report. Because banks do not operate on prove wrongdoing first. They operate on, if this looks off, escalate now. That is how the incentives work. The employee who misses something suspicious creates a problem for the bank. The employee who overreacts creates a problem for you. Guess whose pain the system prioritizes? Exactly. The house always wins, unless you know the rules. And the rules are not just the famous ones. Everybody has heard some version of a reporting threshold. A number, a limit, a magic line. People obsess over the line like it is a video game boss. Stay under it. Split transfers, break up cash, move slower. Use roundabout routes. Bro, that can make you look worse. Because modern monitoring is not just one number. It is behavior, pattern deviation, velocity, counterparty novelty, cash intensity, timing, fragmentation. The machine does not only ask, how much? It asks, does this fit the person we think you are? And that is where normal people get trapped. Because your account has a personality profile. Not officially called that, maybe. But functionally, yes. If your account usually pays rent, groceries, utilities, and one streaming service, then suddenly it sends a large wire to a new recipient. That is a behavior shift. If your balance usually sits low, then suddenly you park a year of expenses there. That is a shift. If you receive a big incoming transfer, then rapidly move pieces out. That is a shift. If you send several similar transfers close together, trying to stay under the radar, congratulations, you just became the radar. That is the dumbest part. People try to look invisible and accidentally start glowing. Here's the street translation. The algorithm does not know your life story. It knows your pattern. And if your real life changes faster than your pattern history, you get friction. So let's make this painfully practical. What triggers attention? A sudden change in spending behavior. Big round number transfers. New payees with no history. Rapid movement after a large deposit. Cash deposits that do not match your normal profile. Repeated smaller transfers that look structured. Transfers with no supporting documents ready. And the one nobody respects enough, doing a totally normal thing, but doing it suddenly, with zero preparation, after years of inactivity. That last one catches older savers all the time, because they think boring history protects them forever. Sometimes it does the opposite. It makes deviation louder. Meet Angela, 42, good salary, low drama, built cash slowly. She thinks she is being disciplined. No risky bets, no weird assets, just stacks money in savings. On paper, that sounds mature. In practice, she is running into a two-headed trap. One head is visibility, the other is decay. Let's do the decay first, because this is where the quiet theft happens. Inflation means your money buys less over time, not in theory. At the grocery store, at the pharmacy, in your insurance premium, in the contractor quote that somehow doubled while you blinked. Now compare that to what a plain checking account often pays. Basically decorative interest. A fake mustache on a robbery. Even many ordinary savings accounts lag badly when inflation runs hot. So if your account pays a tiny yield and prices rise faster, the real return is negative. Translation: you are losing purchasing power while feeling safe. That feeling is expensive. Say Angela leaves a large chunk of cash sitting still for years. The number on the screen barely changes. That is why people relax. But the number that matters is what that cash can do. How much rent it covers. How many months of food. How much medical flexibility. How much negotiating power in an emergency. And that number is shrinking. Slowly. Then obviously. Then painfully. This is why I say the regular bank account is often the worst place for excess cash. Not emergency cash. Excess cash. Important difference. A bank account is useful for liquidity. Bills, transfers, short-term buffer, payroll landing zone. But once the pile gets much larger than your near-term needs, the math starts turning against you, because the bank is not letting that money sit idle. You are. The bank takes pooled deposits and puts them to work. Lending, investing, treasury operations, spread capture, street translation. They borrow your patience cheap, then monetize it somewhere else. And if your account pays almost nothing, you are basically donating optionality. You absorb the inflation hit. They keep the flexibility. That is not a partnership. That is extraction with branding. Now, before this turns into blind paranoia, let me give you relief. The answer is not to hide cash under a mattress. That is just inflation with dust. The answer is cash architecture, meaning different jobs for different buckets. Your main bank account should not be a storage locker for your whole financial life. It should be a transaction hub. That's it. So what is the ideal leftover amount? A solid baseline is several months of essential expenses in highly accessible cash. Not your total net worth, not every liquid dollar. Just enough to handle job disruption, urgent travel, medical nonsense, car repair, or a landlord surprise. For some people, that means 3 months. For others, 6. If your income is unstable, maybe more. If your household has multiple earners and low fixed costs, maybe less. But the point is simple. Leave enough for speed. Do not leave everything for comfort theater. Everything above that needs a better assignment. Option 1. Higher yield online cash accounts. These are designed to keep money liquid while paying materially more than dead checking balances. Reliability is usually high if you verify the institution structure and insurance setup. Access is usually fast, but not instant like a debit swipe. So this bucket works for money you may need soon, but not tonight. Think short runway cash, home repair fund, tax buffer, moving reserve. Option 2. Short-term government paper, very short maturity, high clarity, low drama. The appeal here is not hype, it is structure. You know the maturity date. You know roughly what role it plays. And in some places, the tax treatment can be more favorable than ordinary bank interest. That part depends on jurisdiction, so do your homework. But as a category, this is the kind of instrument people ignore because it sounds boring. Good. Boring is underrated when the job is capital protection. Option 3. Inflation-linked government bonds. These are built for one specific war: purchasing power erosion. They are not magic. They have rules, timing, holding considerations, and sensitivity to how inflation is measured. But conceptually, this is the opposite of pretending your checking account is good enough. This is saying, if inflation is the threat, let me at least examine tools designed for that threat. That is adult money behavior. Option 4. Brokered deposit products and spread out insured cash solutions. Fancy phrase, simple idea. If deposit insurance caps matter, concentrating too much at one place creates unnecessary single-point exposure. Some platforms and account structures let people distribute cash across multiple institutions or products while keeping it more organized. Liquidity terms vary, so read them carefully, because available and available fast are not always the same sentence. Still, for larger cash balances, this category matters. It is how you stop treating one branch login like the center of the universe. Option 5. Liquid money market funds. Not all cash alternatives are identical, but this category exists because many people want three things together: stability focus, better yield than dead cash, and relatively easy access. These are not checking accounts. They work differently. They carry different mechanics. But for operational cash above your immediate buffer, they are often part of the conversation for a reason. The reason is math. Always math. Notice what I am not doing. I am not yelling one perfect answer. That is guru behavior. Real cash management is matching the tool to the job. Immediate bills, emergency reserve, near-term planned spending, capital waiting for a decision, large temporary balances after a life event, different jobs, different parking spots. That is the cheat code. Not chasing excitement, removing laziness from the structure. And if you are thinking, cool, I'll just move it all tomorrow, pump the brakes. Large money moves create their own friction if you do them sloppily. So if a big sum is about to hit your account, prepare before it lands. This matters for inheritance money, insurance payouts, business sale proceeds, property transactions, retirement distributions, family settlements. Any event where your normal account suddenly stops looking normal. Step 1. Know where the money is supposed to go before it arrives. Not vaguely, specifically. Which account handles what role? Which institution is for daily operations? Which is for short-term reserve? Which is for capital you do not need immediately? Step 2. Keep documents ready. Sale agreements, settlement letters, insurance statements, proof of source, transfer memos. Whatever makes the story legible. Because when compliance asks questions, clarity beats outrage. Step 3. Avoid weird behavior that looks like you watched a bad forum thread. Do not start slicing transfers into oddly similar amounts. Do not spray money to brand new recipients without context. Do not panic if a hold appears and start hammering multiple channels. That just creates more noise. Step 4. If you know a large legitimate transfer is coming, communicate early when appropriate, not with a dramatic speech. Just enough to reduce surprise and confirm what documentation may be needed. Boring preparation saves emotional damage. Step 5. Keep your transaction account boring on purpose. That is a power move. Use it for normal flow. Do not make it your warehouse, your vault, your investment bucket, and your emergency bunker at once. One tool, one job. Meet Denise, recently widowed, receives a large insurance payment. She leaves everything in the same regular account because grief kills bandwidth. Completely understandable. Then comes the second mistake. Family asks for help. A contractor needs a deposit. A car gets replaced. A relative suggests a transfer. Suddenly, emotionally charged decisions are happening through the most monitored, least optimized bucket she has. That is how people get squeezed. Not by criminal behavior, by life. And life is messy. The system is not built to feel your context. It is built to score patterns and reduce institutional risk. That is why you need your own system first. A small personal treasury map. Nothing fancy, just rules. How much stays instantly available? How much moves to better yielding liquid cash? How much gets separated by purpose? How documentation gets stored? Which moves require a pause before execution? That little map changes everything. Because once you have a map, you stop improvising with large sums inside the most visible bucket. And that is the whole point. This video is not about hating banks. Banks are tools, useful tools. But only a fool uses a screwdriver as a hammer. A regular bank account is for convenience, payroll, payments, access, daily movement. It is not automatically the best place for long-term idle cash. It is definitely not automatically the safest place for oversized reserves. Safe from what? That is the real question. Safe from theft, maybe. Safe from inflation? Usually no. Safe from monitoring friction? Definitely not always. Safe from your own lazy defaults? Absolutely not. So here is the closing move. Tonight, figure out your true monthly essentials. Then calculate how much you actually need in immediate access cash. Then look at everything above that amount and ask one question. Is this money here because it has a job or because I got comfortable? That question will expose the whole game. Because the system is betting you will assume these rules apply to criminals, rich people, or somebody else. Meanwhile, your parents leave 6 figures parked in a sleepy account. Your uncle gets questioned over his own transfer. Your savings lose buying power in slow motion, and everybody calls it playing it safe. That phrase has cooked more people than bad investing ever will. Don't let them play you. Listen to what they're actually saying. When the bank says convenient, ask whether it is also efficient. When the account says stable, ask whether it is also preserving value. When the system says routine, ask what happens the second your life stops being routine. That is how you protect capital. Not with panic, not with ego, with structure, with documentation, with liquidity where you need it, and better tools where you do not. And if somebody older in your family still thinks a giant checking balance equals safety, send them this. Seriously. Because the most expensive financial mistakes are usually the boring ones. The ones hidden behind familiar logos, soft language, and a monthly statement that looks calm while your money gets weaker. That is the scam. Not dramatic enough for headlines, just constant enough to matter. And now you know where the trap is, how the monitoring works, what behaviors trigger attention, and how to build a cleaner cash setup without doing anything shady. Use the numbers, use the structure. Stop storing oversized cash like it is 1997. The fine print has changed, the machine has changed. And if your money strategy has not changed with it, you are not being careful. You are being outdated.